On February 26, 2022, the global financial system changed forever. Most people didn't notice. The stock market shook a little, oil prices jumped, headlines ran for a few days, and then the world moved on. But behind the scenes, something irreversible had happened. Something that no empire can take back once it begins. On that day, the United States and the European Union executed what many analysts called the most powerful financial attack in modern history. They cut Russia off from the SWIFT global payment system and froze over $300 billion of Russian foreign reserves. It was supposed to be the ultimate economic knockout punch, a strike so devastating that no country could ever hope to recover. The goal, openly stated by American and European officials, was simple: crash the Russian economy, collapse the ruble, and trigger political crisis inside Moscow. For the first few weeks, it looked like a victory. The ruble plunged. Russian banks were on the brink of failure. Lines formed outside ATMs. Hundreds of Western companies announced their exit from the Russian market. The White House called it a financial nuclear bomb, but there was a problem, one that Washington had overlooked. The bomb didn't just hit Russia, it hit the entire global financial system, and with it, the long-term credibility of the US dollar itself. For decades, the backbone of American power wasn't its military. It wasn't its economy. It was something more subtle, more elegant, and far more powerful: the US dollar's dominance in global trade, finance, and reserves. If America wanted to pressure a country, it could do so without firing a single bullet. Just freeze accounts, block transactions, cut access to SWIFT. The world had never seen a tool like it. But once America deployed this weapon at full strength against Russia, major G20 economy, nuclear power, and a key energy supplier, something unexpected happened. Countries all over the world began asking a dangerous question: if it can happen to Russia, could it happen to us? That single question ignited a chain reaction. Banks across Asia, Africa, Latin America, and the Middle East began reevaluating their exposure to dollars. Central banks accelerated gold purchases. Nations began quietly reducing their U.S. Treasury holdings. Energy exporters started negotiating oil deals in other currencies. China began pushing its alternative to SWIFT SIPs far more aggressively. Because for decades, the dollar's dominance rested on one assumption: that no matter what, the United States would never weaponize the global financial system against major economies. It might sanction small countries like Iran or Venezuela. It might freeze assets belonging to terrorist groups or criminal networks, but it would never target a G20 nation. That assumption died in February 2022. In this video series, we will explore how that single decision triggered a global shift already reshaping the next century of geopolitics. We'll look at the 5-stage pattern that historically destroys the world's dominant currency. Well, I'll see how. Britain made the same mistake with the pound sterling in the early 20th century and how it lost its empire as a result. We'll examine how Russia survived the financial attack that was supposed to cripple it. And we'll reveal how more than 50 nations are now building a new global financial architecture, one designed explicitly to bypass the United States. This isn't speculation. This isn't conspiracy. The data is clear. The dollar's share of global reserves has dropped steadily for 25 years. China's CIP's payment system doubled in size in 3 years. Saudi Arabia, after nearly 50 years of petrodollar loyalty, now sells oil in yuan. Central banks bought more gold in the last 3 years than at any time since the 1970s. BRICS is now larger than the G7 by real GDP. What's emerging is not the end of the dollar, but the end of dollar hegemony. The end of America's ability to print unlimited money, export inflation to the world, and enforce global compliance through financial dominance. This is the beginning of a new era multipolar currency world where the United States is no longer the unchallenged center of global finance. And it all started the moment the SWIFT weapon was fired. The 5-stage pattern every empire repeats, and why it always ends. Badly, history doesn't repeat itself perfectly, but it rhymes with an uncomfortable precision. Whenever a superpower rises to dominate the world economy, the same sequence unfolds again and again, almost like a law of nature. Economists pretend that currencies rise and fall because of charts, models, interest rates, and trade flows. But beneath all of that, there is a deeper political pattern, a psychological pattern, that determines the fate of every monetary empire. To understand what is happening to the dollar today, you must understand the five-stage cycle that ended every currency before it: the Dutch guilder, the British pound, and now, slowly but unmistakably, the US dollar. And it always begins with Stage 1: control. Stage 1. The dominant power controls the global payment system. Every empire begins with innovation, a new financial system that is so efficient, so trusted, so universal that the world adopts it without question. For the Dutch Empire in the 1600s, it was the Amsterdam Exchange Bank. For Britain in the 1800s, it was the sterling-based gold standard. For the modern United States, it was the dollar, Bretton Woods, and later, SWIFT. Control doesn't mean coercion, it means trust. The world uses your currency because it's convenient, stable, and safe. You don't have to force anyone. They choose it because it works. For decades, the US dollar provided exactly that: the safest asset, the deepest markets, and the strongest legal protections. The result? 80 to 90% of global trade touched the dollar in some way. Even countries hostile to the US relied on its financial ecosystem. Every empire in history begins at this moment, when the world believes its money is the center of gravity. But that moment never lasts. Stage 2. The dominant power begins to weaponize its system. Over time, the superpower becomes overconfident, starts to believe that its currency dominance is permanent, guaranteed, something that can be exploited without consequences. So it begins to weaponize the system. Britain did this first in 1914 during World War I, when it froze German assets and cut Germany out of the global financial network. At the time, it looked like a brilliant move, a bloodless victory, but it planted the seed of the pound's decline. After the war, countries like France and the US no longer trusted Britain with their reserves. They quietly diversified. Confidence cracked. The United States followed the same path. The first major use of financial weaponry came in 1956 against Britain and France during the Suez Crisis. Then came Iran, Iraq, Libya, Venezuela, Afghanistan. Dozens of smaller nations watched their assets seized or frozen. But in 2022, the US made the same mistake Britain made a century earlier. It used the financial weapon against a major power, not a small sanctioned state, not a rogue regime. But Russia, a G20 economy, the world's largest energy exporter, and a nation deeply integrated into global trade. That moment marked the transition into Stage 2. And once a dominant power crosses this line, Stage 3 becomes inevitable. Stage 3. Targets build alternatives. No country wants to be financially strangled. No leader wants to live under the threat of having their nation's savings frozen with a keystroke. So the targeted powers begin to build parallel systems. Germany responded to British sanctions in 1914 by reorganizing its financial structure, accelerating independence. China responded to earlier US sanctions by building CIPS, its alternative to SWIFT. Russia, after 2022, moved nearly all of its trade to non-dollar currencies and built its own domestic equivalent, SPFS. And something crucial happens during this stage. Alternatives that once seemed unnecessary suddenly become viable. The world sees that there is life outside the dominant system. Survival becomes proof of concept. The moment Russia survived being cut off from SWIFT, dozens of countries suddenly realized we don't actually need the US financial system to function, and that realization spreads faster than any sanction. Stage 4. Neutral countries hedge their bets. This is where the dominoes start falling. Countries that are not enemies of the empire, but not loyal allies either, begin to hedge. They start diversifying their reserves. They reduce their exposure to the dominant currency. They sign bilateral trade deals and other forms of money. Buy more gold. They build regional mechanisms. They don't revolt. They simply prepare. Saudi Arabia begins selling oil in yuan. India buys Russian oil in rupees. Brazil signs agreements with China to settle trade in local currencies. African nations join BRICS+. ASEAN discusses reducing dependency on the dollar. None of these countries hate the US. None want a conflict. But all of them watched what happened to Russia and decided they didn't want to be next. This is the most dangerous stage for the empire, Because confidence doesn't collapse loudly, it erodes silently. Stage 5. The weapon loses power. Here is the final paradox. The more the dominant currency is weaponized, the weaker the weapon becomes. When Britain weaponized the pound, countries diversified. When the pound lost its central role, financial sanctions became meaningless. Within 30 years, the pound lost its reserve status. The same pattern has now begun with the United States. The dollar won't disappear. It will remain important. But it will no longer be the unchallenged supercurrency, the tool of effortless power. Its ability to dictate global behavior through financial threats will weaken. Sanctions will become less effective. Countries will find alternatives. And once the world no longer fears your weapon, the weapon is no longer a weapon. This is the stage the U.S. has just entered. How Russia survived the financial death sentence when the United States and the European Union cut Russia off from SWIFT and froze $300 billion of its foreign reserves. Western analysts were certain they were witnessing the beginning of Russia's economic collapse. Headlines predicted the fall of the ruble. Commentators spoke openly about regime change. Some even compared the moment to the Soviet Union's collapse in 1991. But something extraordinary happened. Something that shocked economists, infuriated policymakers, and reshaped global strategy. Russia didn't collapse. Russia adapted and then stabilized. And in some ways, it came out stronger. This was the moment the world realized the financial nuclear bomb was as unstoppable as everyone believed. To understand how Russia survived the death sentence, we must break down the 4 major pillars of its unexpected resilience. 1. The ruble rebound. How a currency written off for dead came back to life within days of the sanctions. The ruble crashed. Western media declared it worthless. But Russia's central bank executed a set of rapid, decisive countermeasures, actions that many economists believed impossible in modern markets. A. Extreme interest rate hike. The central bank raised rates from 9.5% to 20% overnight. Freezing capital flight. B. Capital controls. Foreign currency transfers out of Russia were restricted. Exporters were required to convert a large portion of their earnings into rubles. C. Energy-backed currency demand. Then came the real masterstroke. Putin declared that unfriendly countries must pay for Russian gas in rubles. Overnight, the ruble was no longer a speculative currency. It was now backed by global energy demand. Within 3 months, the ruble was not only stable, it was stronger than before the sanctions. This was the first crack in the narrative. Currency under attack had recovered because Russia turned its natural resources into monetary leverage. 2. The energy pivot. The world still needed Russia. Western governments expected the global community to isolate Russia. But the world didn't follow. Europe cut imports, but Asia opened its doors wider than ever. India increased Russian oil imports by more than 1,000%. China expanded its purchases across oil, gas, coal, and metals. Turkey, the UAE, Saudi Arabia, and African states continued trading. Energy markets don't follow ideology, they follow supply and demand. And Russia supplied 10% of global oil, 20% of global natural gas, and enormous quantities of wheat, fertilizers, and metals. Cutting Russia out completely was impossible. So instead of collapsing, Russian exports simply flowed to new buyers. Western sanctions reshaped global trade, but they didn't eliminate it. They shifted energy routes toward Asia, solidifying a new economic bloc outside Western influence. The embargo designed to isolate Russia ended up isolating the West from cheap energy. 3. The rise of parallel financial channels. When Russia was cut from SWIFT, many believed it had been unplugged from the global economy. But SWIFT is only a messaging system. It is not a payment processor, nor a currency reserve, nor a bank. Russia quickly turned to alternatives. China's CIPS. CIPS transactions with Russia exploded, doubling in less than 2 years. The yuan became Russia's most traded foreign currency. B. Domestic systems. Russia used its internal SPFS system to keep banks connected domestically and with select foreign partnersc bilateral currency swaps. Countries like India, Iran, Turkey, and China established direct currency mechanisms with Russia. Bypassing the dollar entirely, the digital payment alternatives, the Mir payment card network, expanded rapidly, gaining acceptance in dozens of countries. The world realized something astonishing. SWIFT was not irreplaceable. This revelation alone permanently changed how nations view the dollar-centric system. For the sanctions backfire, how pressure created self-sufficiency, sanctions were meant to cripple Russia's industrial base. Instead, they forced the country to rebuild supply chains domestically or through non-Western partners. A. Agriculture. Russia became more self-sufficient, expanding its role as the world's largest wheat exporter. B. Energy infrastructure, gas pipelines, LNG terminals, and export routes shifted decisively toward China, India, and the Middle East. C. Manufacturing, while Western companies exited the market. Local companies and Chinese firms filled the vacuum. D. Technology and imports. Despite restrictions, parallel imports through Central Asia, the Caucasus, Turkey ensured that consumer goods continued flowing. Russia didn't become richer, didn't become stronger overall, but it became sanctions-proof in ways few expected. And this resilience sent a powerful message to other nations. If Russia can survive, so can we. That message spread further than any sanction. Why Russia's survival changed the global system forever? For decades, the threat of being cut from the dollar system was enough to force global compliance. It was the silent weapon behind U.S. diplomacy, feared but rarely tested. When Russia survived the ultimate test, that fear evaporated. Countries realized, you can build parallel systems, you can settle trade in other currencies. You can survive without SWIFT, you can resist dollar pressure. You can diversify foreign reserves, and you can protect your sovereignty. The U.S. didn't just punish Russia. It accidentally proved to the world that the dollar-based system is no longer absolute. This was the turning point. The world after sanctions. By 2024, over 40% of Russian trade was done in non-dollar currencies. The yuan became the most traded currency in Russia. BRICS expanded to include major energy exporters. Central banks worldwide accelerated gold purchases. Dozens of countries started reducing their exposure to U.S. treasuries. The sanctions meant to destroy one nation instead transformed the global financial landscape.
The global revolt against dollar dominance for decades. The global financial system rested on a simple truth. The US dollar was the center of the world. It powered trade. It settled debts. It served as the primary reserve asset for nearly every nation on Earth. Countries didn't just use the dollar, they depended on it. The dollar was stability, security, and predictability wrapped into one. But after February 2022, after Russia survived the most aggressive financial strike in modern history, the world quietly began reconsidering that dependence. A new fear emerged, one far more powerful than ideology or economics. If the US can freeze Russia's reserves, what stops it from freezing ours? That question ignited a global shift. Not dramatic, not chaotic, but systematic and strategic. One nation at a time, the world began hedging against the dollar. 1. The Middle East cracks. The petrodollar foundation India expanded rupee payment mechanisms, especially for discounted Russian oil. In Africa and Latin America, countries often suffer from dollar volatility. When the dollar strengthens, their local currencies collapse. As sanctions expanded and dollarized debt became heavier, these regions began seeking alternatives. Argentina adopted yuan for part of its reserves. The shift wasn't anti-American, it was pro-sovereignty. After 2022, BRICS evolved from a loose club into a cohesive bloc seeking financial autonomy. Its expansion, adding Saudi Arabia, UAE, Iran, Egypt, and Ethiopia, connected major oil exporters, rising economies, and key trade corridors. The group began building local currency trade mechanisms, a shared settlements platform, alternative payments infrastructure, discussions on partially gold-linked trade instruments. BRICS isn't replacing the dollar, it's diluting its monopoly. 6. The collapse of fear for decades. The US sanctions system was effective because countries feared it. But Russia's survival changed everything. If sanctions couldn't crush Russia, a G20 economy, why would smaller nations fear them? That fear evaporated, and once the fear disappears, the system loses its grip. The global shift is not an attack, it's an evolution. The world isn't abandoning the dollar, it's outgrowing it.
The rise of BRICS, gold, China's financial empire, while the world was quietly drifting away from the dollar. Three pillars of a new financial order began rising: BRICS, gold, and China's expanding financial ecosystem. Each force alone could shift global dynamics. Together, they are reshaping the architecture of international finance. 1. BRICS expands into a global power bloc. Once considered a symbolic alliance, BRICS transformed after the SWIFT sanctions. Its expansion brought together the world's largest commodity producers, emerging markets, and critical trade hubs. BRICS now includes Russian energy, Chinese manufacturing, Indian markets, Saudi and Iranian oil, African minerals, and trade routes. This coalition isn't unified politically, but economically, it is complementary and motivated by a shared goal: reducing vulnerability to Western financial pressure. BRICS initiatives include a BRICS-based settlements, currency, digital payments networks, credit systems insulated from U.S. control, gold-backed settlement discussions, infrastructure banks, independent of the IMF. The intention is not to overthrow the dollar, but to build parallel systems that reduce dependence on it. 2. CIPS. China builds the new arteries of global finance. China's CIPS system is becoming the backbone of trade across Eurasia, Africa, and Latin America. As China's trade footprint expands, CIPs expands alongside it. CIPS offers sanction-resistant settlement, deep integration with China's banking system, fast digital payment capabilities, support for yuan-based contracts, lower cost than SWIFT for many partners. Countries trading with China increasingly see yuan settlement as convenient and low risk, especially when sanctions loom in the background. This isn't the birth of a new global reserve currency, it's the birth of a global trade currency. 3. The yuan. A competitor, not a conqueror, China's yuan is rising, but not as a direct replacement for the dollar. Its strength lies in China being the world's largest exporter infrastructure across Asia, Africa and Latin America, digital payments leadership, bilateral trade agreements, currency swaps with dozens of nations. The yuan is evolving from a regional currency into a transactional currency for global commerce, especially where the dollar is politically risky. For gold, the ancient asset becomes the modern hedge. Gold's dramatic comeback is one of the least discussed but most important trends. Central banks buy gold because it cannot be frozen, it has no issuer, it bypasses sanctions. It stores value independent of politics. It provides credibility for new settlement systems. Some analysts believe BRICS may eventually launch a gold-linked settlement token, not a domestic currency, but an international tool for trade. This would combine digital speed with metal-backed trust. Such a system would not dethrone the dollar, but it would reshape global trade financing. 5. A decentralized, multi-currency world emerges. The new world system isn't dominated by one currency. It is built around plurality. Dollar for global finance, euro for regional trade, yuan for Asian and commodity markets, gold for central bank reserves, digital platforms for settlement, local currencies for bilateral deals. Power is shifting from a monopoly system to a network system, one less susceptible to any single nation's leverage. 6. China steps into an unexpected role, ironically. China isn't replacing the U.S. as a hegemon. Instead, it is offering something different: infrastructure. China is building payment rails, currency swaps, digital currency systems, trade networks, gold accumulation mechanisms, bank partnerships throughout developing regions, while America built the last financial empire. China is building the next financial architecture. The dollar is not collapsing. The U.S. economy is not imploding. America is not disappearing from the global stage. But something fundamental is ending. Dollar hegemony. The era when the United States could shape global events through the power of its currency alone. The future will not be post-dollar. It will be post-dollar dominance. 1. The multipolar currency era begins. For the first time since World War II, no single currency will dominate all aspects of global finance. Instead, different currencies will serve different roles. USD gives global finance, investment. Safe haven EUR gives regional trade and regulatory influence. RMB gives commodity markets and Asian supply chains. Gold gives reserve stability. Digital currencies gives transaction efficiency. This is not chaos. It is diversification. 2. Sanctions become less potent in a world with multiple payment systems, CIPS, SPFs, BRICS Pay, digital settlement rails. Sanctions lose their universal reach. They still work, but only against nations deeply embedded in the Western system. Countries will increasingly insulate their reserves: energy trade, manufacturing, supply chains, banking systems, essential imports. From us leverage, sanctions aren't disappearing, but their era of absolute power is ending. 3. The U.S. loses its exorbitant privilege for decades. The U.S. enjoyed a unique advantage. It could print dollars and the world would absorb them. This allowed massive borrowing and global influence without the usual consequences. But as more trade shifts to yuan, gold, or local currencies, global demand for dollars slowly decreases. U.S. deficits become harder to finance. Inflationary pressure rises, borrowing becomes more costly. Long-term treasury demand weakens. This is not collapse. It is normalization. The U.S. will operate under the same constraints as other nations, not above them. For geopolitics becomes more balanced. A world with multiple financial centers distributes power more evenly. Asia gains influence. The Middle East gains leverage. Africa gains negotiation power. Latin America gains independence. Europe becomes a regulator rather than a follower. BRICS becomes a platform for alternatives. No single nation dominates. No system is universally obeyed. This reduces American control, but it also reduces global fragility. 5. Digital finance becomes the glue of the new system. Central bank digital currencies, CBDCs, instant settlement networks, and blockchain-based trade rails will allow fast, transparent, and secure cross-border payments. This digital layer will connect currencies that previously couldn't interact efficiently. It will lower transaction costs, reduce political risk, accelerate local currency trade, make sanctions easier to circumvent. Weaken the dollar's technical monopoly. The future is digital, fast, and decentralized. 6. The dollar's slow transformation. The dollar doesn't fall. It evolves. It becomes a major global currency, a powerful financial asset, a stable store of wealth, a dominant but not exclusive medium of exchange. America keeps influence, but shares the stage. This shift is not a crisis. It is a correction. The world is not ending the dollar. It is ending the monopoly of the dollar. The final truth, the collapse of dollar hegemony, is not a single moment. It is a process, slow, quiet, gradual, not through war, not through revolution, but through alternative choices, one transaction at a time. A multipolar currency world isn't a threat. It is the natural evolution of a world no longer defined by a single superpower. And it all began the moment the global financial weapon was fired and the world realized it could survive without the dollar. Future: a multipolar currency world and the slow death of dollar hegemony.